Nobody sounds an alarm when a bubble starts to form. There aren't any blaring headlines or frantic sell-offs. Instead, it usually begins with a quiet consensus, a subtle shift in sentiment. These 7 stocks are different. They're special. Today, just 7 companies account for about 36% of the entire S&P 500 index. That means more than a third of the market's value is riding on the shoulders of a select few. It's a remarkable level of concentration. A market that's supposed to represent the breadth of American business is now heavily tilted toward a handful of giants. Call it what you want, but that's not diversification. That's everyone crowding onto the same horse, convinced it can't lose. The risk isn't hidden, it's hiding in plain sight. And here's the thing, this isn't a new story. We've seen it before. Travel back to the late 1960s and early 1970s. Investors fell head over heels for a group of stocks dubbed the Nifty 50. They weren't speculative startups or fleeting trends. These were the titans of their time. IBM, Coca-Cola, McDonald's, Disney, Polaroid, Xerox. Blue-chip companies with global reach and formidable reputations. People called them one-decision stocks. The idea was simple. Buy these leaders and forget them. After all, they owned their industries, controlled iconic brands, and delivered reliable profits year after year. Why worry? By 1972, the Nifty 50 swelled to nearly 45% of the S&P 500's total value. Almost half the market was concentrated in a short roster of names. Investors felt safe, rational, almost inevitable in their confidence. Now, fast forward to today. Apple, Microsoft, Nvidia, Google or Alphabet, Amazon, Meta, Tesla. The Magnificent Seven. It's a different cast, but the script is strikingly similar. These are real businesses with real profits. Their products and services touch billions of lives. Whether it's cloud computing, smartphones, social media, or e-commerce, these companies shape the modern world. But it's not just that investors want to own them. Index funds are compelled to buy them, again and again. Here's why. The S&P 500 is weighted by market capitalization. As a company's value grows, its share in the index rises, and index funds automatically increase their holdings. Every paycheck contributes to this cycle. Every retirement plan, every passive investment. Money flows in, no questions asked, and the largest companies get an even bigger slice of every new dollar. It's mathematical, mechanical, and it creates a feedback loop. Big companies get bigger, which attracts more capital, which makes them bigger still. It feels safe. It feels routine. It feels like the rational thing to do. But that's exactly why it's risky. Back in the 70s, the Nifty 50 didn't collapse because their businesses failed overnight. The companies kept making money, selling products, and innovating. What changed was the price. Many traded at 50, 60, even 90 times earnings, valuations that demanded picture-perfect growth year after year. Then reality intervened. Inflation soared, interest rates climbed, economic growth slowed. Suddenly, even the most admired companies became lousy investments. Their share prices slid, slowly, then sharply. Over the years, most Nifty 50 stocks dropped 50 to 70%. Some took more than a decade just to recover their previous highs. It wasn't that the companies faded into obscurity. It was that price finally caught up with reality. Expectations had simply gotten too far ahead of what even the best businesses could deliver. Look at today's market. The Magnificent Seven have driven nearly all of the S&P 500's recent gains. Strip them out, and the rest of the market looks ordinary. Not terrible, not spectacular, just average. The whole market's performance is leaning hard on a tiny group, counting on them to keep defying gravity. If anything goes wrong, slower growth, regulatory pressure, higher interest rates, the impact won't be limited to just their shareholders. The whole market could feel the effect. Yet, who's worried? It doesn't look or feel like a bubble. There's no wild speculation, no frenzied trading, just steady, confident buying, almost a sense of inevitability. That was the mood in the Nifty 50 era too. It all seemed so professional, so sensible. Everyone owned the same names, bought into the same logic. The consensus felt comforting. But that's the catch. The safer something seems, the less we question the price we're paying. Overconfidence doesn't show up as euphoria. It often masquerades as prudence.
This isn't a prediction of doom. History doesn't move on a set schedule, but the pattern is hard to ignore. Too much concentration, too much automatic buying, and almost universal belief that this time things are different. Maybe things really are different this time. Or maybe, as history often shows, warnings don't come as alarms, they come as whispers, barely noticed, until it's too late.